Good morning, everyone. Today, please note that today is the second and last class that we're making available to everyone to be able to attend the online classes. The timetable is already on our website, which shows exactly when we're having the classes. Remember, generally, our classes are every second week, and each class is 3 hours long. So please take note of the timetable that is on the website as well. And please note that during the course of the year, we are looking to add two or three slots on top of this, because remember, whatever happens by end of October, we should be done going through the curriculum. So if there's a need, we might add 1 or 2 slots to the timetable as well, but only when there's a need for us. But remember, our goal is by end of October, we should be done going to the study units, so that November, December, January, until right in February, we did get that period for vision, where we go through past question papers as well as past assignments as well. So the agenda for today's class is for us to be able to finish study unit 1. Remember, there are 12 study units that we need to go through. So today we need to make sure that we finish study unit 1, so that in the next class, we're going to be moving on to study unit 2 as well. So if you check in our study guide, please take note that as you go through the curriculum, try as much as possible to stick to the study guide, because the study guide will tell you exactly what under each study unit, what is the goal of each study unit, and which chapters and sections from the different textbooks are we going to be covering to complete each study unit as well. So you see that for study unit 1, the main aim of study unit 1 is to introduce us to credit risk analysis and management. And looking at this, we see that from study unit 1, we have already covered chapter 1 from Bandoyapadi, and the video has been made available to everyone as well. So please know that we have already covered chapter 1 of Bandoyapadi, according to the study units, and the video has already been made available to everyone as well. So the goal of the next study unit, which is so the goal of the next chapter or book in the study unit is for us to cover chapter 2 of the book by Witzany, and then chapter 2 of the book by C.B. Joseph as well. So which means today our aim is to complete these 2 chapters from these books, so that we know that by the end of the day, we are done going through the study unit as well. And remember, they say at the end of this study unit, remember we've covered the book by Bandoyapadi, and these were the learning outcomes that we expected. And then there's also, we need to cover the book by Witzany as well. And when it comes to the we need to cover the book by Witzany, and then we also need to cover the book by C.B. Joseph. And the outcomes that are expected to be taken note of here is that we should be able to address the question, what do you mean by credit risk analysis? And we should be able to explain the traditional 5 Cs model explain how the traditional 5 Cs model is augmented in modern credit risk analysis. And then we should also be able to answer the question, one of your friends argues that borrowers need to study credit risk analysis because it is the territory of the lending business. So it does not need to study credit risk analysis because it is the territory of the lending business. And do you agree? And please elaborate your answer. So these are some of the outcomes and potential questions in the exams that one can encounter when it comes to these books and sections that we need to go through as well. So when you look at the book by Witzany, where we are introduced to credit risk management, which is chapter 2 of the book by Witzany, they say we need to discuss, firstly, the appropriate or recommended models of credit risk organization, as well as the separation of powers, both in the case of classical banking, like for example, in this case, or corporate business activities, as well as in the case of trading and investment activities. So those recommendations, in fact, go hand in hand with the Basel risk management process standards as well. So when you look at credit risk organization, they say the first and the most important requirement for a sound banking credit risk organization is the separation of powers between the risk management and the business side. A possible organization structure of a universal bank involved in commercial, corporate, and retail bank, as well as an investment bank, is shown in figure 2.1. So the risk management division of the bank is headed by the chief risk officer, who should be a member of the management board. So which means in this case, this is where they look at the different divisions, where this is the shareholder and the supervisory board. Then we have the CEO, and then we also have the internal audit and control. And under them, this is where you find the investment banking division, business, products and making, operations and IT, the CFO function, and the credit risk officer, which with the credit risk management as well, does the credit risk management as well. And from here, we see that from the business organization, the credit risk management and product design as well, there are different activities that they're going to be embarking on, where from a business organization and credit risk management, they need to look at the credit risk rating, limit setting, collateral appraisal, credit approval, risk margin setting, credit monitoring, and workout collections as well. And then they also look at the product and process risk assessment as well, when you look at the product design as well as the credit risk management, which means the credit department is going to be working hand in hand with the different departments of the organization as well. So here they go on to say, the business divisions, investment banking and marketing should report to other members of the board. So the risk management is close to the finance and accounting sections of the bank, which are usually directed by the chief financial officer. So the responsibility of the chief risk officer and the chief financial officer can possibly be delegated to just one member of the board. Another controlling unit close to the risk management is the internal audit and control section, which stands above all other departments and divisions in terms of risk, in terms of control and auditing supervision. So the interdependence of the internal audit and risk management sections is often strengthened by direct reporting to the supervisory board, which acts on behalf of the shareholders. So there is also a compliance department responsible for adherence to legal and regulatory requirements. So if the bank belongs to the large banking group, then the chief risk officer is usually nominated by the superior risk management of the group and is only formally appointed by the chief executive officer. So the credit analysis, the setting of exposure limits, estimation of expected losses, entering the risk margin calculation, and final transaction approval should be optimally done independently of those officials who take care of the client's business. So an important component of the approval process is the assessment of collateral, in particular of real estate, which must also be controlled by the risk. So credit risk management may and usually does delegate certain limited approval responsibility to the business unit. So which means now we look at the review of the credit process. So which means when you look at the review of the credit process, this is where you now look to say, how does what is involved from the time a client says, or potential client says, they want to be able to be given credit by a lending institution until the lending is given to the client, and then post the giving out of the lending to the client, to the funds to the client, as well as what needs to be done as well in the future when it comes to the lending process of the organization as well. So we look at the review of the credit process. And here they say, so when you look at the lending, remember here, when you look at the lending process, we're basically saying that we are looking at it from a perspective of a financial institution like a bank. So we're looking at it from the perspective of a financial institution like a bank. And when you look at, for example, a bank, right, which is the lending institution, the accounting equation says the assets is equal to equity, that's liabilities. So if the asset is equal to equity plus liabilities, in this case, the equity is the ordinary share capital of the business. Remember? So this is the ordinary share capital of the business, which means that this is the capital that belongs to the owners of the business. So any capital and reserves that belong to the owner of the business is your equity. Then we also know that from the bank's perspective, there is going to be liabilities. Remember, liabilities, money coming from external parties. And the typical money coming from external parties is money coming from depositors. So it's a liability to the bank. And then there is also other debt that the bank can also be able to access it. So, like, for example, when they access overnight money market instruments and so on. Then, from the asset of the bank, in this case, the assets of the bank is basically those that generate income for the bank. So, which means that any income generating activity of the bank, whatever asset that they're going to be using to generate income for the bank, it's basically what you're going to be finding on the asset side. And in this case, the bank gives out loans to customers, different types of loans to customers, and to generate a return. In this case, the return would be, for example, through interest that's going to be charged by the customers when they get the loans. And then there's also going to be securities that the bank is going to be investing in as well. So which means that the bank is also able to invest in securities, and all these are meant to generate a return to the organization. So all these are expected to generate a return to the organization. So which means that's how the accounting equation of the bank typically looks. So which means when you now look at these loans that the bank is going to be giving out to customers as part of their income generating activity as well. Now the question is, so what is the credit process that is followed from the point where the customer is indicating interest in getting a loan until the loan is approved? And then over and above that as well, what is involved after the loan has been approved as well? So this is how we're going to be analyzing the credit process of a typical financial institution like a bank in this case. Are we on the same page? Any questions? Anyone lost so far? So where we look at the credit process of, for example, of a bank in this case, the credit process is shown on figure 2.2. Please take note that figure 2.2 is a very common question when you look at past question papers and past assignments. So this concept that we're covering now, it's one of those highly examinable questions in the exam or in the assignments. And the reason why the lecturer loves this particular concept is mainly because how the lecturer can typically ask you this question. If you look at the assignment from 2023, May 2023 assignment 1 of 2023, you see that a typical question that the lecturer would ask you is where they say, you are required to identify a lending organization of your choice, be it a bank or a retailer, and outline the credit process. In your own words, provide details of each phase. So do you see that the reason why the lecturer would love this particular question is mainly because it's open-ended. There is no way two students can have and analyze the same institution or the bank, and when they analyze the same bank, everything is going to be exactly the same. Very difficult to do that. So which means this is the reason why, because your exams are going to be online and it's going to be open book as well, it basically means that to avoid situations where students are copying from each other as well. That's why you see that for Rsk4804, the lecturer loves these open-ended questions because it means that you as an individual, you are going to be now having to think for yourself, think of an organization of your choice, and then from the organization of your choice, analyze its credit process in your own words, which means there's no way your wording can be, even if you're going to be analyzing the same bank as well, there's no way your wording and your structure is going to be exactly the same as the next student as well. So this is typically how the lecturer asks you such a question when it comes to the exam or even the assignments as well. Are we on the same page? So now, going back to the credit process, we're going back to the credit process. So the credit process is typically involving 3 phases. The first phase being the credit origination, the second phase being monitoring, and then the third phase being the workout phase. So in the first phase, which is credit origination, which we are going to be discussing here following the lecture, the author's discussion of this as well, the responsibility for the credit origination falls with the business units as well as the credit risk. And when you look at the activities under origination here, this is where you look at the credit rating, the evaluation of applications, risk-adjusted pricing, where you need to adjust your interest rates according to how much risk one is taking, what is against how much is the risk profile of the client that you're considering giving credit to, and then there's also collateral evaluation as well. So here, then under monitoring, this is where we are saying that once the credit has been originated, where the credit has now been approved, the next phase now is to say, amongst the customers that we've given credit to as well, how do we now monitor these customers? So which means the responsibility falls with the different business units. The responsibility falls with the business units, the credit risk, but analyzing the credit risk as well as the market risk as well. So which means in this case, you are under the activities of monitoring. This is where you're looking monitoring and identification of cases turning bad. So this is where, for example, the credit rating of the customer now starts deteriorating. And then you also look at reclassification or provisioning of bad loans. And then you also look at taking any corrective actions as well. Then the last phase in this case is the workout phase. And the workout phase is that phase where we say, in the case where the customer ends up defaulting, what can we do? So which means under the responsibility, the main responsibility there is to ensure debt recovery. So which means we need to make sure that our recovery rate is as high as possible and we limit the loss given default as well. So which means the key activities is the recovering of bad debts and also closing unsolvable cases as well. So these are the key activities when it comes to the workout phase. So when you look at the discussion by the author says, the key role of risk management does not end with the approval and granting of a loan to the client. So the overall credit process and the split of responsibilities can be schematically illustrated in figure 2.2. So the corporate clients should be obliged to submit regular financial reports, which need to be monitored by the client relationship officials, as well as by credit analysts. If the reports or other information indicate a worsening of the client situation, then the corrective action should be taken. So the action may be stopping of any new withdrawals, negotiation with the client on the initiation of early repayments based on existing contractual covenants, and recommendation to change the current business plan. So the last phase of the credit process, which already belongs to the workout phase when the exposure turns bad. So since the client relationship officials tend to underestimate the problems, and remember, the reason why the client relationship officials are tempted to underestimate the problems is mainly because, remember, this is the sales department. They want to sell as many loans as possible to the customers. So sometimes they might end up underestimating the problems that might that they might end up underestimating what the problems as well, because they're basically estimations. So they say the exposure should be transferred to a different specialized unit, which may be under the responsibility of risk. So the workout activities could also be under the business side management, but all events, there should be a change of personnel and organizational responsibility in the case of bad client that is going through bankruptcy or restructuring. So that's why you see that when you look at the different phases there, we have business units that are being involved there. Then the workout phase, it means that ideally you want someone that is going to be different from the business units that are involved in the selling and in the origination and monitoring of the monitoring of the debt as well. When it comes to monitoring of the debt, it means that you now ideally for monitoring in the workout phase, this is where you're now going to be having more and more personnel coming from the risk management side as well, to ensure that what there's objective assessments of the clients. So they also say the monitoring of retail loans is more mechanical and usually based on the so-called behavioral scoring. So the process of collecting retail loans will, with delayed repayments, normally starts very early with the so-called soft collection method, whereby the clients are contacted by phone. It may end by selling or outsourcing of the defaulted loans to specialized collection companies that initiate possible legal steps, the sale of collateral, or executions. So provisioning is a very important part of the monitoring process. So provisions reduce the receivable net accounting value in order to reflect expected losses. So the provisioning process is governed by the International Accounting Standards or the IFRS standards, but should be in principle consistent with the Basel 2 or 3 or the economic valuation process approach. So provisioning is usually connected to the classification system, classifying performing loans as standards and watch, and non-performing or impaired as class as substantial or doubtful loss as well. So which means when you look at the expected losses as well, this is where our provisioning for the expected losses, we are basically saying that when it comes to, when you look at the pricing of the credit as well, remember we said typically the pricing of the credit would involve the calculation where we say, so the pricing of the credit, this is where we are trying to estimate the expected losses coming from here. So this is where we're looking at estimating the expected losses arising from here. So which means the calculation of the required of the interest or the pricing of the credit as well is where we're going to be saying, coming from the formula we said your nominal rate is given as your real rate plus expected inflation plus risk premium, where the real rate plus expected inflation is basically your risk-free rate. And typically, the risk-free rate or the proxy for the risk-free rate is given as, for example, the return on short-term government bonds. So which means the return on short-term government bonds is basically what we can use as a proxy for the risk rate of return, which means when you're not going to be charging an interest rate to the customer, when you're charging an interest to the customer, you need to check to see exactly what is the risk rate of return, then how much over and above the risk rate of return are we going to be charging depending on the risk that the customer is going to be having. So means the higher the risk of the customer, the higher the risk premium, so that we're able to cater for the expected losses as well. Are we on the same page? So for the expected losses that are coming from here, we cater for the expected losses by charging. When we charge an interest rate here, we also take into account the expected losses. So when we charge an interest rate here, when it comes to the pricing of these, we also take into account this is how basically we charge the interest that we're going to be charging the customer. And remember, this interest rate, the overall interest rate, is based on expected losses. Unexpected losses, we are going to be discussing them shortly as well, because remember, these losses that are going to be suffered here, they are not always going to be expected losses. There is also unexpected losses as well. So there's also unexpected losses. And how do you cater for unexpected losses? You cater for unexpected losses by ensuring that you have enough capital available. So you cater for unexpected losses by ensuring that we have enough capital available to absorb these unexpected losses. Are we on the same page? So when an organization gives out credit, it means they also need to take into account provisioning of potential losses as well. And how do you provide for potential losses? Which means in the pricing of the credit that are going to be giving out customers as well, we also need to take into account the risk premium, which means with the risk premium, we're also going to be provisioning for potential losses as well. Are there any questions? Any questions so far? Any questions?
Trainers, hi.
Mm-hmm. Hi.
Do we have access to the marked notes that you're going through in your drive?
Yeah.
Okay.
Are you registered as yet?
Yes, I am.
All right. Remember, please take note that the first class that we did, which is the orientation class, I demonstrated how to maneuver the website to get all the material, to get the videos, to get this the soft copies of the textbooks, which are already highlighted, as well as to get the revision material when it comes to the revision period as well. So please, I will reshare the orientation video because that video is very, very important. Even those who are on the trial version as well, I'll reshare the orientation video if you don't have it, because on that video, I demonstrate how to maneuver the website and how to get the soft copies of the textbook, which is already highlighted with a bit of notes on it as well. So I would recommend that you go to the video, the orientation video, because everything is covered there, and so that you know how to maneuver the website and where to get the material as well. Are we together?
Thank you. I'm very familiar with your website.
Right.
Thank you.
So if
Thanks.
you haven't received, I will reshare the orientation video on the different groups. If you are not registered with us as yet, please ask or request for the orientation video. Although I try as much as possible to share the orientation video, because there's a link that we did where the orientation video is made publicly available, which means I share links on those orientation videos so that people know exactly what to expect and where to get what as well. So I will reshare this on the different WhatsApp groups. And if you're not registered with us, I will please let me know so that I also share the orientation video as well. So that once you're registered with us, you are able to access. I think even those who are on the trial version as well, there is a link for you to be able to access these soft copies of the textbook. Because we're not selling them, we're just making them available to everyone.
Trainers, please help us with the first assignment as well. It's coming up.
Remember, the assignments, we are going to be assisting you with the assignments. So you'll see that from tomorrow onwards, I'll be communicating with you regarding the assignments. So we are going to be assisting with assignments as well. All right. Are there any questions before we move on to the next paragraph? Any questions? All right. On the next paragraph, they say, last but not least, we should mention the importance of data for good credit risk management. First of all, the bank should be able to filter out clients where there is serious negative information, including the bank's own experience from the past. For example, if a client engaged in a fraudulent activity when applying for a consumer loan, his or her application should be automatically rejected if the client applies for a small business loan, and vice versa. So this may be seen trivial, but requires well-organized and interconnected databases covering all available sources of information. That's why you see that many financial institutions, they always have a central database where they're able to openly share information as well, because the more information one has, the more they're able to mitigate their risk exposures as well. On section 2.2, we look at trading and investment banking. And here they say, trading and investment activities should be, in principle, separated from the commercial banking. There should be a Chinese wall preventing the investment part of the bank from using insider information obtained from clients in the classical credit process. So moreover, the monitoring of financial market instruments exposures is, in general, very complex and goes hand in hand with the ability to price and quantify the risk associated with the instruments as well. So they also go on to say the importance and difficulty in investment banking credit risk management is underlined by the bankruptcies of and huge losses suffered by the leading market players during the recent financial crisis, even those that has been assumed to represent the best practice in the markets like JP Morgan and Goldman Sachs. So which means that when it comes to the investment banking section of the business as well, they are basically saying that they do follow the same principle where they have securities that are going to be investing in as well. And in these securities that are going to be investing in as well, it means that there is going to be risk that is going to be involved in investing in these securities. So any losses that are going to be suffered here, how are they going to be absorbed by how are they going to be absorbed by the capital as well? Which means that you need to make sure that there is enough capital to absorb the unexpected losses coming from the investment banking part of the organization as well. Because if they don't take into account these unexpected losses when they invest in these securities as well, it means that the ordinary share capital is going to be wiped out. And if the ordinary share capital is wiped out as well, it means that the investment banking division of the bank as well is going to result in what? Losses, especially when it comes to the depositors. Because remember, the depositors just expect to deposit money into the bank, and they don't worry about the investment banking or any other investing activities of the bank as well, which means that if there's going to be any losses there, they are not even worried about, because the only thing that they worry about is that if I deposit 500 range today, I'm expecting that at any point in time, I should be able to access my 500 rand as well, regardless of what the bank is using that money for. On section 2.3, we look at the Basel credit risk management requirements. Now, when you look at the Basel credit risk management requirements, we are going to look later on. We're going to look at the evolution of the Basel Accords. And when you look at the evolution of the Basel Accords, it's all going back to the accounting equation of the bank, where we are saying when it comes to the bank, to generate a return for the bank through the bank's assets, it's either they're going to be giving out loans to customers or they're going to be investing in security. But now, in the pricing of these loans as well, for example, it's always going to be an expected loss that can be suffered as well. But remember, in the pricing of loans, for example, the interest rate that's going to be charged by all the customers, they also take into account the risk premium so that they're able to anticipate these expected losses as well. But now, the Basel Accord is now looking to say, so what are we going to do in the instance where there is unexpected losses? Because where there's unexpected losses, these unexpected losses end up being significant and too large that they threaten the going concern of the bank. So which means, the Basel Accord is now saying, do we have enough, or does the bank have enough capital available to absorb these unexpected losses? Because if they are too big compared to the underlying capital available, what is going to happen? The bank's going concern is going to be affected. And if the bank's going concern is going to be affected as well, it means that especially the depositors are going to lose faith in the banking system. And if depositors lose faith in the banking system, what is going to happen? People are now going to start putting money under the mattress. And if people are putting money under the mattress, what is the other risk as well? Is that the financial resources are not going to be allocated to the most efficient user of those financial resources, which means instead of putting this money in a bank where those who are able to utilize that money to make more money within the financial system as well are going to be borrowing from the bank, the customers are going to end up putting the money under the mattress, which means there's going to be lack of efficiency in the use of what? Financial resources as well. So which means you see this quite a lot when you look at the most recent example where you look at VPS Bank, where there were customers now who were waiting outside for hours on end, hoping that since the bank was facing problems as well, they were hoping that they are able to recover their money that they would have that would have been lost as the bank was facing financial difficulties as well. And we also know that when it comes to the bank, we're going to look at it in chapter 2 of CB Joseph as well, where you look at the activities of the bank, where the same 100 rand, because of the movements of money within the financial system as well, the same 100 rand can be lent out to so many other people as well, because depending on exactly what the deposit requirement should be on every lending activity as well. So are we on the same page so far? Any questions?
Renas, in the exam, would you be expected to calculate the expected losses and unexpected losses? What is a typical exam question?
The expected losses, we are going to look at calculation of expected losses, because there's a formula that you use in calculating the expected losses, where you say your expected loss is given as your probability of default multiplied by your exposure at default multiplied by your loss given default multiplied by the term to maturity of the loan. So we will be able to take into account and calculate the expected losses. Now, when it comes to the unexpected losses, you are practically not able to know the unexpected losses in advance, right? Because they're unexpected. So which means, how do we cater for the unexpected losses? That's when we look at so for the unexpected losses, that's when we're going to be looking at the Basel Accords. So we look at the evolution of the Basel Accords to cater for, to see exactly how does a bank account for these unexpected losses. So how does it anticipate and provide for these unexpected losses so that there's enough capital to cater for that? Because remember, when it comes to these unexpected losses, you find that to cater for these unexpected losses, this is where you look at the bank having a capital requirement. So which means to cater for these unexpected losses, there's going to be a capital requirement, and the capital requirement calculation has evolved over time. Because you're going to say, like, for example, typically in South Africa, you're going to say 10% of your risk-weighted assets is going to be the capital requirement that needs to be set aside here. So which means this capital requirement is what I'm going to be saying, whatever your risk-weighted asset is, 10% of that is going to be the capital requirement to cater for unexpected losses. Then for these expected losses, That's when we look at calculation of the expected loss. We're going to look at it in the coming sections, where with the expected loss is given as your exposure at default multiplied by probability of default multiplied by the loss given default multiplied by the term to maturity. But we're going to look at this in detail in the coming sections as well. Are we on the same page? Any questions?
Thank you.
So on section 2.3, where we look at Basel credit risk management requirements, they say the credit risk management organization principles are not only recommendations based on the author's experience, but also follow the Basel banking regulation. Before we point out the most important parts of the regulation related to the subject, let us firstly review the development and overall structure of the current regulatory framework. The goal of the Basel II regulatory framework is to set a higher risk management and internal control standards for banks all over the world, as well as to introduce a new, more risk-sensitive approach to the regulatory capital calculation. So in this case, this is where we look at when they talk about the BCBS, this is where they're referring to the Basel Committee on Bank Supervision as well. Then in this case, when you look at when you look at the brief overview of the historical development of the Basel Accord, we are going to look at it in detail in the coming chapters as well, where you look at to see, we started off with the Basel I, where with the Basel I, the committee took, remember we said here, our aim is to make sure that we have enough capital available, right? So which means how to make sure that we have enough capital available, we're going to say 10%, because remember in South Africa, the capital requirement as a percentage is 10% of your risk-weighted assets. So how do we ensure? So now the question becomes, how do we measure these risk-weighted assets so that we're able to take into account the capital requirement as well? Which means when you look at the evolution of the Basel Accord, the first risk that they were more concerned with was operational risk. But now, over time, they realized that operational risk is not only the risk that is faced by the banks as well. There is also market risk. And then, so which means because there are other risk factors that even over and above the market risk that needs to be catered for as well. That's why you see that the Basel Accord started evolving to say, yes, we also need to take into account market risk. Then they also started evolving where they also need to take into account so many other factors as well to ensure that there's enough capital available to absorb these potential unexpected losses. So the idea is to say, what calculation can we do to ensure that we have enough capital available to cater for these unexpected losses? So which means if we're going to be taking into account credit risk, we're going to say, how do we calculate the risk-weighted value of the risk-weighted assets which are exposed to credit risk? Then you say 10% of that becomes your capital requirement. Over and above this, we also say, how do we take into account market risk in calculating the risk-weighted assets? Then you say 10% of that is going to be the capital requirement. Then you also go on further now when you look at the evolution of what? Of the Basel Accord. So that's basically what the Basel Accord is propagated on. The main idea behind the evolution of the Basel Accords is to ensure that we have enough capital available to cater for these unexpected losses in case they do occur, so that they were able to protect the going concern of the bank, especially when it comes to the depositors as well. Are there any questions? So moving on, they say the first capital accord, which is the BCBS of 1988, was officially published by the Basel Committee on Banking Supervision, representing the regulators of the most developed countries. In 1988, with an implementation deadline of in 1992, the accord, which we refer to as the Basel I, was amended to incorporate market risk in 1996. At this time, discussions on a new regulatory framework had already started, and the first consultative paper was published in 1999. After receiving many comments from banks and national supervisors, a second consultative paper was issued in 2001. So the new capital accord, which is the Basel II in this case, was finally published after long and numerous discussions, as well as a number of quantitative studies in June 2004. The document was updated to incorporate certain relatively minor issues in 2005. A comprehensive version incorporating the market risk part was published in 2006. In order to put the new accord into practice, it had to be implemented into national legislation and related frameworks. So specifically, the European Union published the implementation directive in June 2006. So the Capital Adequacy Directive had to be further incorporated into the national legislations with the EU. So the Czech National Bank published the corresponding provision in June 2007, and for the first year in which the new approach was fully applied by banks in the Czech Republic, and similarly in other European countries, was 2008. So the financial crisis then which began in mid-2007, have driven the Basel Committee to propose new amendments and modifications to the accord. The final version of the amendments to the Basel II framework, in particular in the area of securitization, as well as the revisions to the market risk framework, were published in July 2009. And finally, in December 2010, this BCBS approved another reform of the framework called the Basel III. And the Basel III does not change the approach to the calculation of capital requirements for classical credit exposures. It does, however, enhance capital requirements for market risk and introduces a new new severe capital requirement. So for banks, the most challenging part of the new regulation lies in the strengthened capital requirements for quality of capital and in the introduction of the new capital conservative and countercyclical measures. Other new important requirements are relatively simple leverage and liquidity limits. So so there is also an important shift in the EU implementation, where the capital and liquidity requirements now take the form of a regulation directly applicable to a single rule book to member countries without national discretion, while the supervisory assessment principles remain in the form of directive as well. Please note that for Rsk4804, we don't necessarily need to know these developments intricately. Just understand the evolution of the Basel Accord and what it's trying to address as well. But for Rsk4805, the lecturer typically loves to ask questions where they're asking you regarding the implementation and of the different Basel Accords as well, the timeframes. The lecturer loves to ask such questions in short questions. But for Rsk4804, you don't necessarily have to be worried about the intricacies of which Basel Accord was implemented when. You just have to understand the overall evolution of the Basel Accord and what it's trying to address as well. Are we on the same page? So the figure 2.6 does discuss the overview of the Basel requirement. So figure 2.6 does discuss the overview of the Basel requirement. And here, how do I rotate this? So figure 2.2 does discuss the banking, the Basel Committee on Bank Supervision Reforms, where you look at the Basel 3 as well, where the Basel 3 basically has three pillars. Pillar number 1 looks at the capital, risk coverage, and also where instance where there is what leverage contained. And pillar number 2 looks at risk management and supervision. And pillar number 3 looks at market discipline as well. And over and above, they also look at the issue of global liquidity standard and supervisory monitoring as well. So these are the 3 pillars that are covered when it comes to the Basel 3 the Basel 3. So when it comes to the capital, this is where one is looking at this is where one is looking at the quality and level of capital, and where they say greater focus on common equity, where the minimum will be raised to 4.5 of risk-weighted assets after deduction. So which means that to improve the quality of the capital as well, they're basically saying that the minimum should be of common equity that makes up your equity in this case should be 4.5%. Then they also look at capital loss absorption at the point of non-viability. They also look at capital conservation buffer. They also look at counter-cyclical buffer as well. Please note that these are intricate details, but I don't expect the lecturer to be asking you these intricate details. These details are specifically like what they did here. Then they also look at risk coverage, where you look at securitization, where they analyze the trading book, where you look at the counterparty credit risk, and then they also look at the bank exposure to central counterparties as well. Then they also look at instances where there is what leverage ratio to see exactly how do you maintain the leverage ratio as well. Then there's risk management and supervision, where they say supplemental to pillar 2 requirements, they say address firm-wide governance and risk management, capturing the risk of off-balance sheet exposures and securitization activities. Reason being here, when you look at the 2007 2008 financial crisis, the risk that the financial institution were also facing was from off-balance sheet instruments, like, for example, derivatives as well. So which means that they need to find out exactly how do we account for the risk emanating from derivative to ensure that we have what enough capital available to absorb losses are coming from potential losses coming from them as well. Then there's revised pillar 3 disclosure requirements, which means when it comes to pillar 3, this is where you look at market discipline, where the disclosure requirements are saying the requirements introduced relate to securitization exposures and the sponsorship of off-balance sheet vehicles. So enhanced disclosures on the detail of the components of regulatory capital and their reconciliation to the reported accounts will be required, including a comprehensive explanation of how a bank calculates its regulatory capital ratios as well. Then when it comes to the issue of liquidity, this is where you look at the calculation of the liquidity coverage ratio, the net stable funding ratio, and also the principles of sound liquidity risk management and supervision, as well as the supervisory monitoring as well. So this, which means that these are the different components that are basically making up the Basel 3. Where, remember we said with Basel 1 and Basel 2, they were more concerned with saying, how do we ensure that we have enough capital available to cater for operational credit risk as well as market risk as well. Now, over and above the credit risk and market risk, Basel 3 is now trying to take into account, say, how do we cater for other risk exposure that the bank might also be facing, and how do we ensure that, for example, we have enough capital to cater for potential liquidity issues that are going to be used now in calculating what the capital requirement as well. So this is what they cover when it comes to the Basel 3. You don't necessarily need to know this amount of information in detail, but just understand exactly what each Basel Accord was trying to address as well. Are we on the same page? So here they say, the main guiding principle of the Basel regulation can be seen in figure 2.7. So when you look at figure 2.7, this is what they're covering here. So this is the guiding principle behind what they're discussing here. And here they say, banks regularly suffer credit, operational, market expected or unexpected losses. The expected part of the losses based on the long-term history should be covered from annual revenues. So the unexpected part is not covered by the revenues, but must be charged against the capital. In good years, the actual losses may be lower than expected, but in bad years, the bank needs a sufficient capital buffer. Hence, the goal of the regulation is set up to set up a procedure estimating the potential unexpected loss on a regulatory probability level. So the task is mathematically depicted in figure 2.8. So here, they are saying, when you look at figure 2.7, remember we said we have expected losses and unexpected losses. So the expected losses are the ones that we said that in our pricing of the credit asset, the income that is going to be generated by the bank, because remember, when the bank gives out credit, their return is basically the income that they're going to remember in the income and expenses section, there is going to be in their financial statement, basically, or in the statement of comprehensive income. When you look at the statement of comprehensive income, remember they have the income and then they have the expenses as well, which means the expected losses are going to be reflected by the pricing. Because when they look at the pricing, this is how they're going to be able to generate the income, isn't it? So that if there's going to be any expected losses, they are expected to be absorbed by the income that the bank is going to be generating when you look at the income and expenses of the bank. Now, the unexpected losses now are the ones that we say the bank must ensure that there is enough capital available to cater for these unexpected losses. So when you look at this diagram, we are saying these expected losses are expected to be absorbed when you prepare the income and expenditure of the bank. These expected losses must be absorbed by the income expenditure. Or when you prepare the income expenditure of the bank, where when you look at the income against the expenses, since they are anticipated, they must be absorbed. But in those periods where we have unexpected losses, we must also make sure that these are periods where even when you prepare your income statement, you see that the bank is suffering a loss. So if the bank is suffering a loss, even when you prepare the income statement, so how do we ensure the going concern of the bank? What do? We must make sure that we have enough capital available to absorb these unexpected losses as well. Are we on the same page? So as you can see, these expected losses, the frequency in which they happen is expected to be higher compared to unexpected losses. So the bigger the unexpected loss, the lower the frequency it's expected to happen. So the bigger the expected loss, the lower the frequency in which it is expected to happen. Are we on the same page when it comes to figure 2.7? Any questions? Now, with regards to figure 2.8, they show us the relationship now between expected and unexpected losses. So when you look at the frequency and the loss distribution there, we're basically saying that the expected losses are expected to be anticipated such that when you're calculating the value at risk, the value at risk is basically, by definition, the value at risk, because remember, the value at risk is the risk measure that is used by banks. And how it works is that the value at risk is the maximum loss that is expected to be suffered over a given period of time with a certain level of confidence, whether you are 99% confident or 98% confident or 99.5% confident that the maximum loss that you're expecting to suffer over a given period of time is so much. So, which means when you're calculating your value at risk takes into account both the expected losses and unexpected losses. We're saying, realistically speaking, we are a certain percentage confident that when you take into account expected losses and unexpected losses as well, over a given period of time, the maximum loss we are expecting to suffer with a certain confident level over a given period of time is so much. So which means the value at risk basically tries to account for both expected and unexpected losses. But in reality, we also know that there is a chance that these losses that are being estimated by the value at risk might end up exceeding the certain confidence level, which means that they might end up, if you're expecting a maximum loss to be so much, when you're taking into account expected and unexpected losses, there's instances where the losses might end up exceeding the loss estimated using the value at risk as well. Are we on the same page? So this is what this graph, this figure is trying to explain. Are there any questions there? Any questions? So what you need to take note of is, what is the relationship between the expected losses and unexpected losses, and how does an organization try to account for the expected losses, and how do the organization try to account for unexpected losses as well? Are there any questions before we move on? So on this note, we are done with chapter 2 of Witzany. So on this note, we are done with chapter 2 of Witzany. So what do we take away from chapter 2 of Witzany? Chapter 2 of Witzany is trying to explain to us the relationship between the expected losses and unexpected losses. How we try to absorb the expected losses and how we try to absorb the unexpected losses when you look at this one. So this is the main thing that you need to make sure that you take note of from chapter 2 of Witzany. Are there any questions? All right. If there are no questions, can we take a 10 minutes break until 12:30? Then at 12:30, we are going to move on to chapter 2 of CB Joseph. So can you take a 10 minutes break until 12:30? And then at 12:30, we look at chapter 2 of CB Joseph.